in microeconomics, financial markets and policy. He's a trusted advisor on matters of economics to policymakers and influential source of economic analysis for businesses. Mark?
Thank you, George. It's good to be here. You know, I haven't been in this building before. How new is this? A new building?
Yeah.
Yeah, it's beautiful. Congratulations. Drexel looks fantastic. This is a homecoming for me. Michael Papiano. I haven't seen him in 27 years. You know, we used to be in the same cube together. I was joking. He's got the same hair. A little gray. But, you know. And then Joe Davis. Joe Davis. My gosh, Joe and I used to have a competition. Who would get into the office first? I hired him. And I was the owner, and he beat me into the work. What was that all about? Now he's running the world, and he just hired my daughter. So thank you, Joe. She'll be good. She's, although I'll have to say, Joe, I was FaceTiming with her yesterday. She's at Oxford, getting a master's in financial economics, and today she's taking her corporate finance exam. She said, absolutely positively sure she's going to flunk. So I don't know. We're all nervous. We're all nervous in the Zandy household. Well, anyway, thank you. And, you know, I didn't know exactly what I was going to talk about, but given the topic, global investor behavior, or global investors' behavior in an uncertain world, it dawned on me what I should talk about, and something that's really been bothering me, and that's the lack of volatility in financial markets. Michael, you kind of alluded to it, I think in one of your slides, you had a slide, but here's my slide, just to make the point. This is the so-called VIX index on the S&P 500. I should say, this may look a little different to some of you guys who look at this every day. This is my version of the VIX index, because the CBOE, who's the keeper of this data, doesn't allow me to redistribute it. So I have to reinvent it, or my folks have had to reinvent it. So it's a little bit different scale, but it mimics it very carefully. I'm showing the data back to 1970. This is, again, the VIX. So this is a measure of implied volatility based on options on S&P 500 stocks. So this is 30-day forward look of volatility. I'm showing the data back to 1970. This data always goes all the way back to right after World War II, so there's a lengthy time series here. The average volatility is 0.9 over this period. The red part, the shaded part, is just a standard deviation. And this is quarterly data, so I've smoothed out the volatility, obviously, by just taking the quarterly average as opposed to looking at daily data or time frequencies. Look at the last data point. It is like, you know, outside the band, very unusual. In fact, in Q1, 2017 Q1, that was the lowest measured quarterly volatility on the S&P 500 in the entire series back to World War II. That's how low volatility has been. Now that's bizarre. Right? I mean, just think about the world we're living in and what's been happening. Brexit, Trump, this election in France, North Korea. I mean, there's like all kinds of things going on. In fact, if you look at measures of policy uncertainty, and Michael showed a nice graph of that, it's still, you know, pretty elevated by historical standards, and it's incongruous that we're seeing this very stable environment. And it's not just in the equity market here. If you go look at the implied volatility on the Nikkei, the Japanese index, it's very low. Go look at European markets, implied volatility is very low. It's bumped up in the last week or two because everyone's getting very nervous about Le Pen and that election. But still, even with that, it's low by their standards. It's also in other markets, and now I'm speaking from my mind's eye, but in fixed income markets, volatility has been incredibly low, interest rates very stable. Even currency markets, you know, even with that run up in the dollar back a couple of years ago, you know, it's hard to believe that the dollar on a real broad trade weight basis has gone nowhere for a little over 2 years. guess commodity markets would be the only financial markets where we've seen some real volatility. But broadly speaking, just an incredibly low volatility environment. Hard to explain, at least in my own mind. Now I've got, because I'm an economist, I have an explanation. Not that I can prove it, but I've got a few potential ideas about what's going on. One is growth actually has been pretty stable, particularly here in the United States. Surprisingly, we're in the 8th year of an economic expansion. Believe it or not, we're coming in on 8 years. This is the second longest economic expansion on record. And if you go back and look, it's been 2%-ish GDP growth consistently. A little higher sometimes, a little lower sometimes. You abstract from measurement problems, residual seasonality, and it's incredibly, I write a piece on, draw a graph, it's just a straight line. Job growth also incredibly stable. For the last, we've had 7 years of consecutive monthly job growth, longest in history, creating a couple 100,000 jobs per month, month in, month out, very stable. Growth overseas, not quite as stable, but even there, if you look at global GDP broadly on a purchasing power parity basis, 3% last year, 3% the year before, 3% the year before. A lot of stuff going on underneath, but incredibly stable kind of growth. So that may be part of the reason. QE, that's, I think, part of the reason. Quantitative easing, buying bonds. So you've got central banks, the Fed, the ECB, the BOJ, now the Bank of England buying lots of bonds. So, that's driven interest rates. Of course, we hit the lower bound on short-term rates, brought long-term rates in. And that supports asset prices, so equity values have been supported by all that QE. So I'm sure that's played a bit of a role. And here I'm really speculating, but it feels right. Maybe financial changes in financial regulation post-crisis also matter, because now the global banking system is rock solid because we forced the banks to raise a boatload of capital. Just take the U.S. banks, go back pre-crisis, the Tier 1 capital ratio was 6%-ish for Citibank, systemically important bank. We're now up to 12. I mean, take a meteor in the middle of Chicago to blow out that capital. I mean, that's a lot of capital, a lot of liquidity. Europeans have also stepped up. We're now finally advanced their banks to hold a lot of capital. So our banking system, the global banking system is on much sounder ground than it has ever been historically. There's a lot of capital liquidity and risk management, resolution process, and all the things that people are railing about with Donald Frank are pretty good, and maybe that's led to some of the stability in markets. Now, having said that, where's volatility going to go? Well, up. Why? Because it mean reverts. I mean, this is a financial market, and it will go back to the mean. It will. It's just a matter of time. I don't know. It feels like everything that happens out there feels like a grain of sand. We threaten the North Koreans, we threaten the Iranians, we threaten the Russians, we throw a bomb here, we throw a bomb there. And you got this pile of sand, and you just throw one more grain on. I'm not sure what grain it's going to take, but it just feels like it's all going to come down at one point in time. And I can almost assure you, I can say this with a high level of confidence, we're going to be throwing a lot more grains on the pile of sand. This isn't going to change. This is, buckle in. We have to get used to that. QE is going to end. The Fed's, preparing us for that. It looks like Janet Yellen, before she leaves next year, is going to want to start that process of letting the balance sheet wind down. That means the December meeting feels about right. So she's going to now let she isn't going to sell bonds, but she's going to allow the balance sheet to run off, mature and prepay. They've got a lot of mortgage securities. The ECB, that's a while down the road. They're not, Europe's not even back to full employment yet, so maybe 2-3 years down the road, they'll stop. Well, they may stop buying bonds next year, so that'll be a step away from QE. Bank of England probably will stop pretty soon. BOJ, they'll be buying bonds forever. So, but the QE will not be quite as important constraint on volatility. And the final reason I'm nervous and why I think we mean revert is because asset markets everywhere are very highly valued. I don't know that they're speculative yet. We can talk about what speculation means, but if just look at equity prices. Take the PE ratio, price earnings multiples here in the United States. They're pretty lofty. Fixed income markets feel stretched. You look at credit spreads in the corporate market, pretty narrow. 400 basis points jump over Treasury. That's not 250 where we were prior to the crisis, but that's pretty thin, credit spreads. So valuations are high. So you got a mix of really high valuations, QE going away, and we're still going to be throwing grains of sand on the pile. It feels like that pile is going to go at some point in time. And then let me finally end by saying that this has economic implications. In fact, in my estimation, the biggest risk to the economy in the near term, over the next year or two, is the sensitivity of the economy to the equity market. That it feels like to me, and we've done some work in this area measuring wealth effects, it feels like to me that the baby boomers, me, I represent the baby, I'm the largest age group in the country, me. I'm 57, I'm the mode of the baby boom generation. I'm lying a little bit because my firstborn son is 27, he's the mode of the millennial generation, and because 57-year-olds are dying, he's now going to become the largest single age group. But anyway, my sense is the boomers are hanging out in the equity market to a much larger degree than previous generations at this point in their life cycle because they're not prepared for retirement and they don't know where else to put their money. They can't put it into cash, they can't put it into fixed long-term bonds. The housing market until recently scared the death out of them. So they've been hanging out in the equity market. And the wealth effects, and here we've done a fair amount of work estimating wealth effects on stocks are much higher than they have been historically. So if that mean reverts, that means stock prices will weaken, other asset values will weaken, that means the boomer sees red on their screen, that means, in my view, that they start pulling back on their spending, and that could obviously have very significant implications for the economy. So if you're looking for a downside scenario, that would be it. And let me just end by saying, buckle in.
So our next speaker is Joe Davis. He's come from Vanguard. He's a global chief economist and the global head of Vanguard's investment strategy group. His team focuses on projections on the asset allocations and develops various strategies actually for investments for both the private investors as well as institutional investors. He has been a frequent keynote speaker. He has written a lot of papers in leading academic journals, and of course he has been involved here in our area with the Vanguard group for many years.
Good morning, good afternoon, everyone. Happy to be here. It's funny when I was talking to Mark and was thinking similarly how to kick this off. It is a small world, so how it changes. So Mark gave me my first job, and then with Anna coming to Vanguard. It's funny. It means two things. One is I was very lucky working for Mark. I learned a lot. It also means we're getting older. You said about the gray hairs. I still die. I'm dying mine. I'm not going down without a fight. But my daughter, she's finding them. She's finding them. So happy to be here. I had very similar concerns as you do. Happy to share with you my perspective, our perspective. The one fortunate thing I have at Vanguard, well-run company, we have 20 million investors. So it's not our money, we manage money on behalf of our clients, our shareholders, $4 trillion. So we have some sense in terms of where capital is being allocated across the global economy, and can give you some perspective in terms of the concerns we have, the functioning of financial markets. Sort of sentiment, how is that ebbing and flowing? We see, we have a lens into how those 20 million clients transact on a daily basis. And so, you can see things that sometimes the aggregate data may not be as obvious. But I think thematically have a similar view as Mark. I will only have this one page up here today, and we'll try to make back some time, George. The global business investment, the environment. There's probably not a bigger question in economics than why has productivity been so low? And to ask that question and to try to answer it is the same way to explain. If one has an answer for that, then one has to explain why trade is low. Well, if one explains why trade is low and growth is low, then one has to explain why investment is low. Because that's the ultimate part in terms of what is going on, and it's been certainly frail. Marcus had the data from the IMF, even the recent study, right, that you've released. It's global phenomenon. Investment is lower today as a share of the economy, as a share of the global capital stock than it was 10 years ago. And it seems, I used intentionally the word perplexing because this is in an era where you just walk around, think of your own daily lives. How disruptive is technology being? And Mark just mentioned the financial markets, right? We are in the strongest and longest bull market in U.S. history since George Washington occupied the building down the street. And yet, in a period of strong wealth effects, technological disruption, people talking about the new machine age, we have an environment where investment is really low. Because if you would hear that, you would think investment should be high. Mark's VIX index would also suggest it should be high investment. Right? So what is going on there? I'd say two things. One is, and again, I think some of this has implications because some would look at the investment environment and some very smart people such as Larry Summers will look at the environment and say, listen, we're in the midst or the early stages of what some would call global stagnation. Right? And not only is economic growth low, it's going to get worse still. So not only buckle in, hang your head low. Right, because the best days are behind us, and that the world is going to increasingly become, or the risk is we become increasingly more like Japan, in the United States, in China. Respectfully, and I emphatically disagree with that view because that implies that innovation is over. And I think innovation is far from over. But clearly, we're still left with this question: why is an investment so frail? We know that's what's driving trade. Hearing earlier today. It's why growth is low, and how do we get out of that? Productivity, in my judgment, will return. If you look at long periods of U.S. history, just to use the U.S. because we have the best data, productivity of the past 10 years has been effectively zero. Right? In Japan, it's been zero for 2 decades. Yet, if you look over a long period of time, you know how many times productivity, if you define it consistently, going back 200 years, you know how many times productivity over a 10-year period has been zero in the United States? Any guesses? It's at least once, right? It's at least once. How about 8? 8 times. Output per GDP, output per capita, GDP per capita growth on a 10-year basis. There has been periods when it's been low, right? Now, just because now is the 8th time doesn't mean that it will return. But I look at what's going on in innovation. I look at what's going on disruptive. I can see it at Vanguard and how we have been a part of disrupting, in respect for disrupting the financial services industry. I think it's unlikely that productivity will remain at low level. But nevertheless, this question of investment, is it going to pick up, matters because until we have that pickup, we will not have growth accelerate. And if we will not have growth, and of course if we would have growth accelerate, that has implications for the Federal Reserve, for interest rates. The bond market is exceedingly skeptical that the Federal Reserve will raise rates any more than once. Right? And so that could be a wild card. It could be one of the grain, not just one grain of sand, it would be several grains of sand on the financial market. So this is a key question. I'd say, to focus on the U.S., U.S. investment, I hear it a lot, that investment is low, right? Maybe I will show this chart because I think it's just helpful to fix ideas. This is real investment as a share of the economy. It's a very simple chart. Anyone can download it. I actually downloaded it from Mark's firm, but you can get it from the Census Bureau. Mark charges me money again. I know, not much. But it clearly has stagnated as of late. But it's not low, let's be clear. Right? Real business investment as a share of the economy has been rising for 30, 40 years, but you know, we haven't really broken through at a higher level, right? So this is real non-financial investment, right? Think of everything from commercial real estate to intellectual property to Caterpillar and CapEx and those sort of things. So you know, we haven't really accelerated, and so that's a key question because. You know, if we're going to break out of this 2% sort of growth world, you know, much like we saw the late 1990s, where that blue line really accelerated. Think of hardware and internet bubble, and the internet period where growth was consistently above. You know, that's when we really saw growth. You know, so we would need to see something like that because it's not going to be from the consumer. The consumer has been adding to as much growth over the past 5 years in the U.S. as they were during the previous global financial crisis. Right? So unless we're going to see a run up, if we're going to see healthy, sustainable growth, in my judgment, this blue line has to go up. You can get it from government spending, you can get it from fiscal policy. That has other trade-offs, you know, clearly in terms of our fiscal dynamics. It's the private sector, it's 85% of the economy. This blue line must go up if we're talking about 3% growth. There's no other way around it. So, you know, this is what we focus on. We've clearly seen a significant rise in sentiment. And what we, right, and you know, a nice chart that the National Federation of Independent Businesses, you know, puts together. You know, that has skyrocketed since the election, right? So that's a chance that we get animal spirits, right? That would justify the sort of lofty valuations we have in the equity market. It would justify the wealth effects that we have going forward. And we've done the math. We do it. It's possible that we get to roughly 2.5% this year, but it's unlikely. I think that we get to 3%. This is, you know, that's that series in terms of optimism of small businesses. That jump coincided right after the presidential election. It's not a political statement, it's just a fact of the data, right? This is not a political survey. This is with how they view their own businesses. And of course, the scenario is, does it remain high or does it kind of recede and this reflation expectation start to recede? If I'm a betting person, and I can tell you our internal forecast, they're in scenario B. And it's not a political statement, but we are assuming no fiscal stimulus. We're not assuming any fiscal stimulus on the economy this year. So what does this mean for GDP in terms of growth, and will we see investment accelerate markedly over the next year or two? I think it's unlikely. I think the recovery will continue. The U.S. economy, our theme thematically for the past 8 years, we've used this word resilient. And resilience of the U.S. economy, I think that will remain intact. But I think, you know, even if we would see, you know, expectations of consumer sentiment remain that high and business sentiment that high, it's unlikely we're going to see this sort of 3 or 4% growth that some would at least hope for. So what does this mean? This means, you know, 3 things. I think it means from the Federal Reserve and the policies that we're going to see. You know, we went into the year anticipating a quote-unquote a little bit more hawkish Fed than I think the bond market was expecting. We were of the mind that the Fed was going to raise rates in March, it's going to raise rates in June, it was going to pull into this year tapering. And I think we've had one of the 3, and I think we'll see the other 2. I think the Fed will be much more dovish longer term in terms of what they do, given the structural forces on the global economy, which we can talk about in the Q&A. Secondly, it means the U.S. economy is going to be, you know, it's going to continue to expand. The labor market will continue to improve. That's good for all of us as citizens and as employees or employers. But it's not going to deliver the sort of growth that the financial markets, the equity market is anticipating. Because you know what GDP growth, the U.S. equity market, if you would kind of do the regression analysis, you know what GDP growth the U.S. equity market is assuming today? Any guesses? 4.5%. Not going to get it. So buckle in, darn right. Now Vanguard, we're a long-term investor, right? So we're looking through the short-term noise, but I can tell you, since I've been at Vanguard since 2003, we've had our most guarded 5-year, 10-year investment outlook. Most guarded we've ever had. The last time we were this low in terms of expected returns was 2006. Now we don't anticipate in any way in 2007, 2008. But where interest rates are, clearly muted returns. But the greater risk, this is where, again, as I mentioned, I share with Mark, it is the equity market where there's the greatest risk. there's a 1 in 3 chance that we have a correction given where valuations are and the low level of realized volatility. So as an investor, I think we will have to buckle in. I don't think it's enough to derail the economy, but I think it depends on the shock that's the tipping point, because the wealth effect has been a powerful ally in this recovery, and so this is something that is the one. Hopefully I'm wrong, and we're sitting here happy as a clam with our portfolios. A year from now, there's been a lot to be happy for the past 5 years, but I think it would be unrealistic. As my dad has always said, hope is not an investment strategy, Joe. It doesn't care what the markets, it doesn't care what you want, it'll just deliver what it deems as an appropriate rate of return. And so I think we've got to be on the lookout, because I think it's going to get pretty rough from here on. Thanks very much.
And our last speaker for today is Bill Stone, who is the Executive Vice President and Global Chief Investment Strategist at PNC Asset Management. His team focuses attention on asset allocation strategy. He's been a speaker to many events, and he has been frequent contributor to radio and other programs. He frequently appears on Bloomberg, CNBC, etc., many other media networks, and we're very pleased to have him here. And he's actually he's down the street from us, from Le Beau. Bill?
I like that you mentioned radio, because it's often people say I have a face for the radio, so that's nice to end our agenda here and be the last person in the way. So I thought it was great to kind of come last, because I think I'm a little bit rejiggering a lot of things I was going to say to, in essence, spend some time talking a bit about what I agree with and what I might disagree with a little bit. So just a little bit about about our firm, because I think it's maybe gives you a little bit of insight as to where I may be coming from relative. So we manage about $137 billion in assets, so on a discretionary basis. So my job and my team's job is to figure out hopefully the best place to put those assets on behalf of our clients. So when I think about things, that's the way I'm coming at it in terms of where we want to place things in terms of risk reward and what's going on in the world. And I would say it is interesting. So I'll start with where I agree. I think it is a fearless forecast to say volatility is probably going to go up. I'm in complete agreement with that. Even if you forget the VIX side, just say, hey, you look at the data and it says, and Mark kind of alluded to this, the fact is we've gone much longer than normal just on simple measures of in between even having a 10% pullback in stocks. So it doesn't even matter, that stuff just happens. And there's a lot of reasons we could talk about as to why it hasn't happened recently. And I think he hit on a lot of very good reasons, as good as anyone's going to come up with as to why that's happened, but I think that's fair. I'd say one of the places, again, where I'd agree is, do I expect lower returns out of stocks? And well, you can add bonds, you can add almost any asset class you want to add to it, than maybe the historical, and I'll say I agree again, by the way. But I guess I'm less negative. I mean, maybe I wouldn't call you negative on stocks, because again, long term, talked about the positives. But I kind of frame it in the fact that still relative to other assets, stocks remain relatively attractive. Again, the problem is, and it's a fair thing, there's less room for error, of course, as you get the valuations higher. But I offer that relative to interest rates, you could make a very strong argument that stocks are undervalued. But again, it's relative to interest rates, and you have to have a thought on how much yields go up, etc. So it's a little complicated, but I think it's fair that I think those saying that, and neither of these speakers were talking about that, pounding the table saying stocks are way overpriced and you should run for the hills. I think they're dead wrong in terms of, well, they may turn out to be right, but I don't think that's in fact the case, because you have to look at things as relative to other things you can invest in, because I have to invest in something, because we've got investors that need to retire. We have to try and find the best place to put the money. So in terms of that, so I want to talk, one of the reasons why maybe I'm a little more optimistic in terms of the stock side is I maybe don't put quite as much emphasis on the increase in maybe sentiment post-election. because I do think there's some reason to believe that I'm going to say a majority of the stock increases post-election here in the United States were based on fundamental improvements. So in the sense that, and I use the PMI data a lot, the survey data, because I'm trying to get more recent data and using that in terms of what's going on. So when we went back and looked at that, the interesting thing is since the election, the PMI data here in the U.S., I'm going to use ISM data anyway, had a historically high increase or historically large increase in terms of indicating some better, I'll call it better momentum in the U.S. economy. Every time you went back and looked at that since 1970, you would have seen nice increases, strong increases in U.S. stocks. Now, that also says, there is that interesting discussion out there around, we'll call the PMI data soft data versus some harder data that is most certainly, I'll admit, softer. I think everybody out here would say first quarter GDP here in the U.S. is not likely to look very attractive. Could just be calendar thing. And a lot of reasons we expect GDP to pick up for the rest of the year, so we think the PMIs are probably a better place to think rather than necessarily thinking about GDP here. But I think it's part of the reason why our markets have stalled a bit. But I think you do have to say, in the U.S. anyway, part of the rise was, I think, in anticipation of some policy changes, whether it's, I'm going to pin it primarily on corporate tax reform or a corporate tax cut. You have to admit, no matter what side of the aisle you're on, probably odds of that, at least in the market anyway, they've started to price in lower odds that some of that gets done, or at least it gets pushed out a little bit further. So I think that's at least part of it. In our view, it eventually, I'm going to say at least a cut gets done. Reform is very difficult, so I'm not clear they can get a reform done. But even a cut would help our earnings estimates, and if you price stocks based on their long-term earnings, there is a benefit to the corporate tax cut from that pure standpoint. In terms of Europe, as we think about implications of uncertainty, Europe is a spot that we think about a lot. And it was great timing for this because I like to talk about things that we have a bit of skin in the game on, and Europe is one of them right now. So this weekend we get the first round of the French elections. We certainly know the market seems to be pricing in some amount of that uncertainty. So we've got the French 10-year bonds yielding about 0.7% more than German bonds. That's the average over the past year is about 0.4%. We were all the way up to more than 0.75% more a couple weeks ago. So it seems to be the worries have come down at least a little bit going into this first round this weekend. But most certainly the markets are on edge around that outcome and worries about how the Eurozone fares, or the European Union, I should say, fares over, I guess, the long run if perhaps Le Pen would end up winning through the final round and look to exit. Again, we don't expect that to happen, but you have to be mindful of what the markets are doing. So I guess for us anyway, one of the interesting things is some of this uncertainty out there, I think perhaps gives some opportunity. So, if we're looking for relative values, because I think, I can't remember who said it, but there really isn't any cheap stocks out there. It just doesn't, I can say, well, they're not super expensive, but I also would say there's nothing dirt cheap that I can point to necessarily. But in terms of relative valuations, I would say some of this, to us anyway, has given us an opportunity perhaps in Europe to take advantage of. So we actually just recently, let's say this week, increased our position in Europe in terms of recommendations and money. How we did it, we did hedge the currency risk over there, so our thought is if we're wrong and somehow this goes horribly wrong, at least we've hedged the exposure to the euro and we get back maybe something in terms of relative performance from that. Not to mention, at least if I look at our investors, they're almost completely U.S. domiciled, so their liabilities are all in U.S. dollars. So there is some benefit from us just from a straight risk reduction side of that. So I think that's one interesting side. We'll finish in my last kind of couple minutes here. I thought it's kind of interesting to think about, what has changed in the markets due to what's going on in I'll say this policy uncertainty or, maybe economic uncertainty. So I think, I came into this as I'm not an economist, I'm a financial guy. I started in, analysis in individual securities. I always said, honestly, like I can ignore all this economic garbage because I'm just going to analyze companies and find the best ones and everything else. Kind of the Warren Buffett approach, because that's who I modeled myself best I could after. And I have realized, unfortunately, I have to say, you have to pay more attention than I ever wanted to the macro environment. So for us anyway, when I'm thinking about asset allocation, it is a time since the financial crisis where assets tend to move in unison. That's not always the case, but we had these bouts of risk on and risk off, which make it very difficult. Diversification isn't, well, I'd say it's as helpful in one sense, but it's kind of, you have to go to extremely low risk assets in order to get that diversification. Unfortunately, those don't pay anything typically in terms of while things are risk on, and so it makes it a much, I'll say, a challenging environment. The other part is for us in the investment business, I think it has been part of the challenge for active managers, or those that get compensated to pick stocks and pick individual securities, to actually show any value, because when everything runs in unison with each other, it becomes very difficult to stand out, and certainly the indexes, at least certainly when they're going up anyway, it makes it very hard to beat. Not an excuse for the active management industry, they did enough of their own mistakes, but I do think that has made it worse. And it's not necessarily a bad thing that we get a shakeout, honestly, in that business. I have no issue saying that, because the strong will likely survive, and I think it'll make us better for our clients and for everyone in the long run. I think that's a great thing. Painful for some people in the short run for sure, but I do think it has a bit to do with the environment. So I think the last thing I'd leave you with is, what I spend a lot of time thinking about, and it kind of goes to that European position we've got, is to think about what's priced in, right? So do I think I can get compensated, or our investors can get compensated for kind of taking on that risk, and where we think things will play out in the long run? And that's really what we spend some time trying to figure out, where maybe that possibility to add a little bit extra return will come from you have to say assuming some risk, but risk that you think will pay off. So with that, I'll pass it back.
Last speakers to join me here up front, so we can ask a couple of questions. We have a few questions until we complete the program, and we have the microphone here. Any questions?
I have two questions, one for Mark, one for Joe. First, Mark, I agree with you about asset allocations and how the boomers maybe allocated too much to equities, or even, I'll even go farther and say risk assets in the bond market, high yield, which is equity with a coupon. My fear, and I don't know if you share this concern, is that if and when the Fed renormalizes rates, and I think that mostly happens on the short end, by the way, we see the reversal of a squeezing out effect. The Fed squeezes people farther out the risk spectrum, and they come flowing back the other way, and that presents a problem in risk assets. And we have weakness in the high yield market, which is very tight, and in the equity market. And I'll add something to that. I'm a fixed income market strategist. I see it every day. The financial advisory community, they haven't caught on to the fact that with the aging population, more investors are in the distribution phase, not the accumulation phase, and they're in the same ratios of exposure in the market. And for Joe, you mentioned that we need to see more business investment to get GDP higher, and that's I agree with. But why should businesses increase investment? They haven't had the need to for the past, since in this whole cycle. They'd rather buy back shares, increase dividends. They seem to be meeting any and all demand, which might slow with demographic aging, at least on a per capita basis. Why would businesses rather need to increase investment at this point?
Well, Bill, I didn't mean to give you the impression that I'm pessimistic. I'm not. Actually, my baseline sounds very similar to yours. I was just saying this would be my number one risk. If I were putting together a stress scenario, or a bank doing CCAR, that'd be where I'd focus. And in my baseline worldview, which is relatively optimistic, I think that this tension you're describing between monetary policy and repricing of assets should work out reasonably gracefully. That particularly if the normalization of policy is happening because the economy's good, because you're at low unemployment, underemployment, wage growth is picking up, everything's working out reasonably well, and that's why the Fed's normalizing. And the Fed has shown a very significant willingness to stop, pull back if they feel like they're pressing too hard. Financial markets are weakening. And financial market conditions are now explicitly in their reaction function. So number one is full employment, number two is inflation expectations, number three is financial markets. So they're very attuned to this. Having said that, again, going back to my risk scenario, it's a pretty tricky thing to get that exactly right, particularly, and this is another reason why we may want to buckle in here, is because there's a gulf between what policymakers think will be necessary in terms of future monetary policy and where the federal funds rate will end up. So if you look at the long-run equilibrium funds rate as articulated by FOMC members, which is very consistent with sort of my view, it's 3%-ish, right? That's your R star. And if you look at Fed funds futures and see what it implies, then you extract from all the liquidity issues for teasing that out and the issues with that. The market's saying 2%. Somebody's wrong. It isn't me. It's the markets. So, and so there's adjusting to do, and it's going to be very tricky for the Fed to get market expectations up to that reality, if that in fact is a reality. So I think if you were Bill and doing forecasts and having a baseline, you'd say, okay, this is going to work out reasonably well. We'll manage through. There might be some increase in volatility because of the mean reversion, but everything will be fine. But I'd say, reasonably high probability that we get an alternative scenario that's darker. And that was the point of my talk and the point of what you're saying.
Just in terms of both the capital market outlook, is it on? There you go. Use the switch, Joe. In terms of the capital market outlook and then the investment, I don't see why. I've yet to find a company who's been capital constrained in this environment. The world is awash in capital. I see it every day, and you certainly see it in the financial markets. Part of this, there's a structural element. I think one of this is the element of the dark side of Moore's law, with computer prices dropping at exponential rates. I can tell you at Vanguard, two things. Businesses are hiring, right? So they are investing, but in terms of the sort of GDP arithmetic, unlikely to see the sort of 3% growth that some are hoping for. It doesn't mean that we're bearish on the global economy, but we're unlikely to see that sort of thrust. And it's because of the investment dynamic. There's a technological underpinning to this, and I think the technology and the fact that computer prices are dropping at a nonlinear rate, I think is underappreciated. I can tell you at Vanguard, we buy more computers today than we ever have. We are growing extremely rapidly, but we spend less on technology than 5 years ago. Less on technology than 5 years ago.
Technology is inherently
It's effectively free, right? It's effectively free, and so that's that can inflate the sort of real GDP growth numbers. But that means, if anything, two things. What does that tell you? It means, if anything, inflation is lower than you think, and it means that productivity perhaps is a modest.
Joe, in that chart where you had investment over GDP, was that nominal over nominal?
That was real.
It was real over.
See, nominal over nominal, investment has not picked up. It's been kind of this gradual decline. So part of this, and this gets to why interest rates are not only low, but I don't think interest rates are wrong. I mean, I would be shocked if the 10-year Treasury is above 4% before I retire.
I would agree with you.
Shocked.
I have the same opinion.
Because there's the Global Savings Club. The only person who I've seen in the industry who's really articulate this really well is Barry Eckergreen. For a given level of savings, investment, the cost of investment, the relative price of investment to everything else. So the GDP deflator of investments are dropping at a nonlinear rate. And what does that mean? That means that there's an excess supply over the level of investment. And so there's been Bank of England studies and others that say that's worth by our estimates about 100 basis points in the term premium and long-term interest rates. So that means that all else equal, we won't go as high as we potentially think in terms of long-term interest rates. So again, it's not because we're bearish on the economy, growth, stagnation, so interest rates will never rise. It's not that. It's that there's this savings supply-demand imbalance. So demographics could change that dynamic. I'm a little skeptical. We don't see it, and we haven't seen it in long-term trends in the data because the relationship of demographics with productivity or demographics with interest rates, it's weaker than I would have thought. Certainly weaker than I would have thought. And we don't see investors, at least en masse, we don't see investors draw down their portfolios, by the way. We do not see significant asset allocation changes year to year, month to month, because someone all of a sudden magically hits the year 65. In fact, if anything, we are encouraging investors to take on more equity risk because of longevity risk and the fact that life expectancies are rising more quickly than I think we would have anticipated 10 years ago. So we could see some selling in the financial markets because of some demographic wave. But I don't know. I'm skeptical of that. That's a very, very slow-moving phenomenon.
Very good. I think we have another question. No? Yes.
Thank you for the fascinating talks, actually. It was really, really interesting. I think Michael didn't do the question, but I will do. He showed a very interesting picture of Reagan comparing Trump and the dollar. So, given the talk that you just gave, the risks, volatility, going back, what do you think is going to happen to the dollar?
Want me to take a crack at it? Yeah, Warren. Okay. You can go first. Yeah.
You want me to?
Yeah, you go.
All right. So I guess I'd say at the moment, we don't have a strong view on the dollar, I gotta be honest. So last year, we felt a lot stronger that the dollar was going to be stronger. This year, because I think, all the central bank moves are, I say, baked into things, et cetera, I'm not so clear. Now, if you expect to pick up in volatility, usually the dollar is obviously a beneficiary of that in terms of flight to safety, so that could be the worst reason why you see a dollar go up. I mean, when I talked about our hedging of our Europe position in currencies, it really wasn't us forecasting a stronger dollar, it was more just taking some risk off the table because we just don't know. And sometimes you just got to admit when you don't know and say, well, I'm just going to kind of hedge away what I don't know and we'll see if it hurts me or not relative, but I think I'll be okay.
So my view is the dollar is going higher. One reason is the market's expectations of short rates and the Fed's expectations. And if the Fed's right, that's a surprise, and that means markets are going to have to adjust, and that means stronger value of the dollar. Also, I think we're going to have a very strong, consistent, as we have had, underpinning to the dollar because of flight to quality. I mean, those are the grains of sand, and even if we're creating the grains of sand, we're still the AAA credit, so money comes flowing in. We could screw things up, and that means our dollar will appreciate because people will be terrified. And we're money good. I mean, the Chinese, as a third reason, over time, Chinese want to be part of the global financial system. That means opening up their capital account. That means money's going to flow. And given all the other things going on in China, they want an asset that they can be sure will be with them forever, that no one can take it from them, and they can't take these. That's not our problem, they're not going to take that asset. So, and the final thing I'd say is, we have the same policy mix, presumably, right? I mean, it's Reagan. You have a tight monetary policy, you have an easy fiscal policy, and of course, Reagan actually had the easy fiscal policy. He actually executed on that. We'll see if Trump can. There's a lot, as you can see, a lot of debate about whether he's going to be able to execute. But if he gets some kind of tax relief, if you get some kind of increase in government spending on military infrastructure, whatever it will be, that easing in fiscal policy will conflate with the tightening of monetary policy, normalization of rates, and that's a policy prescription that's consistent with a stronger currency. So I'd say the value of the dollar is going up. Exactly when, I don't know, but 2-3 years from now it'll be higher than it is today.
I'll disagree, just to disagree with more, because we're neighbors.
Oh, now, come on.
I mean.
I thought I was.
No, it makes sense, and again, yeah, as Bill mentioned, right, trying to forecast. It's tough enough to forecast interest rates, let alone the relative, the ratio of the two, which is currencies, but because that is the widespread view in of itself as a contrarian, I'm a little skeptical. I think though, if we could see the two things, I think there's a growing risk that actually the dollar doesn't appreciate strongly as we think. One is I think there's a natural ceiling to how high it can appreciate, unless there's a flight to quality and so forth. I think that if it's risen 25% over the past 3 years on a trade weight basis, if it rises in another 15 or 20%, what do you think is happening to the core inflation and GDP forecast for exports? It's undercutting the very reason why the dollars would be rising. So I think there's a limit. It could clearly go up another 10 or 15%, but I think there's a limit. And then I think what we will maybe see in terms of relative policies, the ECB, I think, will potentially be tapering this year, in part because they're running out of assets to purchase. And the Federal Reserve, if they do what I think that they will do, which is move ahead to tapering, do it very gradual, but at the same time, what hopefully is to not raise short-term interest rates at the same time. So a very extended pause. I mean, like at least a year pause. That could be actually somewhat supportive, less supportive of the dollar, right? Because you would be removing accommodation. This is more theoretical. You'd be removing accommodation, but you're not raising the short rate. So what's worth, if I was at Fed, that's what I would be doing, right? You'd only move one tool at a time. And then let's see how the economy unfolds and see how policy does. It's a lot of moving parts, right? So, but anyway, so that's where we could at least maybe try. If I was a bad person, I'd be treading water on those.
Okay, George, you wrote this down, right? So you're going to invite us back in 2 years and we're going to see who's right. Yeah.
I'm right either way.
Yeah, you're right. Smart man.
Well, let's conclude our discussion with one last question.
I have a question about the length of the U.S. expansion that you guys mentioned and the unemployment rate. Mark, you obviously noted that we're 8 years into the current expansion. And Joe, you mentioned that productivity has declined, I guess, 8 times in the last 100 years. Was that right? I guess that's presumably tied to the cyclical cycle with recessions probably provoking those declines. So I guess, naturally, you probably get questions, that expansions don't die of old age. But if we're presumably at full employment with 4.5% unemployment rate, and if you throw this into probate regression models, eventually time is kind of running out, and the next recession will be whether it's 2 or 3 years, 4 or 5 years down the road. The probability will rise. Of course, it's only just a probability. So I just wanted to ask you guys, what do you think about the probability of recession based on the unemployment rate being as low as it is now?
Go me first. I can do it.
I mean, I can.
I'll fade it.
Go ahead.
So I'm not really, spending a lot of time on the big picture other than, we have an economic team that does it. But I think, I don't know if it's time or whatever, but eventually we will have.
Hey, by the way, you know who your chief economist is?
I do, I know.
He worked for me and
I
hired
do
him.
know that. I do know that. That's why I was a little worried for us. But,
All roads lead here.
I know, I know.
Really old.
Yeah, he's all messed up, that guy. No, he's a good guy. Actually. Thank you for sending him over to us. But I guess I'd say there seems to be. I wonder what you both think, or certainly there seems to still be a fair amount of slack in the labor force in the long run, and also with the whole thought that you can bring technology in so relatively cheaply. I'm not clear that that's.
Hold on 1 second, Bill. You shouldn't really leave. You shouldn't leave. You shouldn't leave. Because I'm going to tell you exactly the day of the next recession.
All right, I'm stopping now.
No, only joking. Go ahead. No, you don't have to pay me money. You want to talk? You want to go?
I mean, you have to look at the imbalances, right, for the recession date. I don't see them, you know, I worry about the overseas in the you know, Europe and China, but the U.S., we don't have those significant, expenses just don't die of old age, right? You look at those imbalances. So the Fed has, a lot has been lodged as criticism of the Fed, but I think that's unfair in terms of tipping us into recession. I think they're still probably around 25%. That's what we went into the year with odds at that level. So I don't see anything immediately on the horizon. I just do worry. Everyone's got the same forecast of roughly 2.5% growth. Mark's complacency chart of version, so it's certainly possible. But I don't see anything in the next 6 months that would say, you know, the economy, given the tightness of the labor market, I think has an extra layer of shock resistance than it would have had 3 years.
Okay, June 2nd, 2020. Here we go. I'm going to give these guys a time of day, but that's okay. And you should know I'm a Democrat. And, that might be an issue. You know, I'm biased. You know, November 2020. So if we're going to have a recession, please, before the election. You're right, though. We're at full employment. What that means to me, the clock starts ticking. And that generally, historically, takes 3-4 years and you have a recession, because one necessary condition for a recession is an overheating economy. So you go past full employment, wage price pressures develop, Fed responds, Fed pushes on the brakes too hard, and it's not sufficient, but it's a necessary condition for recession. That takes time, that whole dynamic. So we're at full employment boom today, and it's going to take 3 or 4 years. Second, necessary condition is an imbalance. And that's in the economy, that's mirrored in the financial system. Think housing bubble, subprime mortgage, internet bubble, equity market, commercial real estate, junk corporate bonds, S&L crisis. Go back to everyone, you can find one. Of course, I can do everything very easily ex post. It's hard to do ex ante, but ex ante, I'm sitting here looking, I don't see the thing that's existential, in part because of regulatory changes, in part because of the long shadow of the recession makes us a little more cautious to Joe's investment graph. But therefore, I think it's going to take some time for that to occur. And my guess is June 2nd, 2020.
Well, I'm not sure about that, but next year the AMT conference will handle the issues of the recession, right? I mean, and Mark and everybody will be here with us to tell us that perhaps it will be shorter than 2020. Anyway, this was my joke, but I don't think it will. We are at the end. I want to thank all the participants, but all the speakers. I want to thank my co-chairs that they work very hard, Vibas, Mike Papaioannou, and of course Yotov. And I want to recognize the support that we received from GIC, Jill and Julia, and from the LeBeau staff, Kevin and Cassie Brown. Thank you very much, and this concludes the 35th annual Monetary and Trade Conference, and I hope by now you know, based on your judgment, whether or not the world is deglobalized or it will be more globalized. Thank you.